Welcome to Hybrid Market Terminal, where macro meets momentum and strategy drives every move. Okay, so retirement planning. For a lot of people, I think the idea brings up, well, a mix of feelings, right? Excitement, sure, but also maybe some anxiety.
Definitely anxiety.
Mhm.
We all know we need that income to last maybe for decades, but then you look at the markets, the choices,
Yeah.
it feels overwhelming.
It does. And there's that nagging worry about fees, you know? Are they just quietly eating away at everything you saved? Our mission today is, well, to cut through all that noise.
Right.
We want to give you a clear blueprint for stability. So we're doing a deep dive into Mark A. Reynolds' strategies from his book, Retire Smarter with ETFs, Income and Growth Made Simple. And honestly, this really feels like a go-to resource.
It absolutely is. And it's important to know where Reynolds is coming from. He's not some academic theorist. He spent 2 decades, actually in the investment world.
Hands-on experience.
Exactly. He's seen firsthand how overly complex products and, frankly, excessive fees can really hurt regular investors. His whole philosophy is about simplification.
Using ETFs specifically.
Yes, using exchange-traded funds ETFs to basically strip away that financial drag, reduce those costs, and give control and clarity back to you, the individual investor.
Man, that clarity, that control, that's precisely what we're after today. Our goal for this deep dive is really to pull out the essential pieces for building a steady, confident retirement portfolio. One that uses low-cost ETFs to generate cash flow that you can count on for, say, 30 years or even more.
And Reynolds promises to help you transform your strategy without, drowning you in jargon.
Which is key.
He really sets the stage well by talking directly to the kinds of worries real people have. He mentions different types, like David, maybe that's you listening, the hands-on type, who wants to understand it all but gets kind of bogged down in the details.
Or maybe Susan.
Right, or Susan, who values simplicity above all.
Right.
She just needs a reliable path to income without needing to check her portfolio constantly. And then there's Mike and Linda, the couple maybe navigating semi-retirement, needing something balanced and actionable.
Sure, it covers different needs.
It really does. That's why I agree. This book definitely earns its place as a cornerstone resource if you're serious about using ETFs to build a resilient retirement income stream.
Okay, let's dig in. Section 1, Chapter 1 in the book, The New Reality of Retirement Planning. Because, as Reynolds points out, the landscape has really shifted.
Massively shifted. He highlights two huge challenges that retirees today absolutely have to grapple with: longevity and inflation.
Longevity first. It sounds like a good thing. Living longer, right? A blessing.
It is a blessing, of course,
Mhm.
but financially, it's a major planning challenge.
Yeah.
Think about it. Previous generations might have planned for, 10, maybe 15 years of retirement.
Right.
Now, the average American retirement is easily 20 to 30 years. And if you're a couple, the odds are pretty high that at least one of you will live well into your 90s.
30 years or more of needing income.
Exactly. So it's not enough just to protect your capital anymore. Your money needs to generate sustainable income, and ideally growing income, for potentially 3 decades or longer. If that portfolio runs dry early, well, that long retirement becomes incredibly stressful.
And then there's the second enemy working against you every single day of that long retirement. Reynolds calls it the silent thief.
Inflation, yeah. It's such an appropriate name. We think of it simply like, oh, my coffee costs more. But the real damage is to your real return.
Explain that difference.
Well, say your portfolio earns 5% in a year. Sounds okay, right? But if inflation was 3% that year, your actual purchasing power, what you can actually buy with that money, only grew by 2%.
Ouch. So just keeping pace isn't enough.
Not even close. If your portfolio just treads water, or worse, grows slower than inflation, your lifestyle will gradually decline. No way around it. The portfolio has to grow dynamically just to maintain your standard of living, let alone improve it.
And this is where ETFs come in as the proposed solution.
Precisely. Reynolds presents them as the mechanism to fight both challenges, longevity, and inflation. They offer instant diversification across stocks for growth, bonds for stability, even real assets, like real estate, for an inflation hedge. And critically, they do it while minimizing that fee drag we talked about. Low costs are paramount.
Okay, this naturally leads us to something many people rely on, or at least have heard of, the 4% rule.
Ah, yes, the old guideline.
The idea that you can withdraw 4% of your starting portfolio value each year, adjust that for inflation, and your money should last for 30 years. It sounds comforting, but Reynolds argues, well, it's maybe too simplistic now.
He argues it's potentially dangerous to rely on it rigidly today. There are several modern factors that really complicate that simple picture. 4 key variables, he points out.
That's the first one.
Market volatility. Specifically, something called sequence of returns risk. SRR.
Sequence risk, right.
Okay.
The order your returns happen in matters.
Hugely. Imagine retiring right before a big market crash, like 2000 or 2008. You're forced to start withdrawing money from a portfolio that's just taken a massive hit.
You're selling low right at the worst time.
Exactly. Selling low from a smaller pot. That initial damage can be incredibly hard to recover from. It can drastically shorten how long your money lasts. So unfortunately, the timing of when you retire relative to market cycles matters a lot.
Okay, that's volatility. What's the second variable undermining the simple 4% rule?
It's the unpredictability of inflation itself. The original 4% studies used long-term historical inflation averages, which were often around 2–3%.
But we've seen recently that inflation can spike much higher and stay there.
Precisely. If future inflation averages, say, 4% instead of the 3% your plan assumed, your real return gets slashed. Your portfolio needs to work much harder just to keep up. You can't rely on those gentle historical averages anymore.
Makes sense. Variable number 3.
Back to longevity. The 4% rule was generally tested for a 30-year retirement horizon. But what if you live 35 years? Or 40?
The original math doesn't cover that.
It doesn't. Relying strictly on a rule designed for 30 years leaves you very vulnerable in those later decades. You need a plan and a portfolio built for potentially longer time frames.
And the fourth variable, this one often gets overlooked, I think.
Taxes. Tax
Yeah.
implications. This is where the beautiful simplicity of just withdraw 4% really starts to fall apart.
Oh, so.
Well, many people calculate that 4% withdrawal based on their pre-tax portfolio value. But if you're withdrawing from traditional tax-deferred accounts, like a 401k or a traditional IRA,
That withdrawal is taxed as ordinary income.
right, and it's not just income tax. Those withdrawals can increase your Medicare premiums. They can affect how much of your Social Security benefits are taxed. You can easily get pushed into higher marginal tax brackets than you expected.
So that $50,000 you plan to withdraw might only be, what, $40,000 or $42,000 in your pocket after all taxes and surcharges?
Easily. And that can wreck your budget. It proves you need a dynamic, personalized withdrawal strategy, not just a fixed percentage rule pulled from a historical study.
Okay, so if we can't just blindly follow the 4% rule, what's the alternative? What does Reynolds recommend for a dynamic strategy?
He advocates for something much more flexible, disciplined, and personalized. It really rests on 3 pillars. First, a detailed spending plan.
Not just monthly bills, right?
No, much more than that. You need to realistically anticipate those big, irregular expenses. Major healthcare costs, maybe that dream trip helping kids or grandkids, home repairs. You need a clear picture of your total annual need, not just the recurring stuff.
Got it. Pillar 1, realistic spending plan. Pillar 2.
This directly tackles that sequence of returns risk we talked about. Build a buffer.
A cash buffer.
Yes, or very safe liquid reserves. Reynolds suggests having 6 to 12 months worth of your essential living expenses set aside in cash or something very close to cash, like a money market fund.
And the purpose of this buffer is?
Peace of mind, especially for someone like Susan, who values safety. But strategically, it means when the market inevitably takes a dive, when stocks are crashing and the news is screaming doom, you're not forced to sell your long-term investments at those depressed prices.
You draw from the buffer instead.
Exactly. You use the buffer to pay your bills, giving your stocks and other growth assets time to recover. It acts like a circuit breaker. It stops short-term market noise from forcing you into bad long-term decisions. It's absolutely crucial.
Okay, spending plan, buffer. What's the third pillar?
Flexibility.
Yeah.
Constant flexibility. You have to be willing and able to adjust your withdrawal rate based on what the market is actually doing.
So not a fixed percentage every year.
Right. Maybe the market has a fantastic year, your portfolio is up 15%. Perhaps you take out 5% that year. But if the market crashes 20%, maybe you only take out 3% that year, relying more on your buffer.
You adapt.
You adapt. You stay engaged with your investments, review them regularly, and maintain that flexibility. That's the modern, resilient approach to retirement income, moving away from rigid set-it-and-forget-it formulas.
All right, that sets the stage for why we need a smarter approach. Let's move to section 2 and look at how Reynolds suggests we implement it. Why does he pinpoint ETFs as the, well, smarter, simpler solution?
Okay, so what are ETFs? Exchange-traded funds.
Nice.
Look at them as investment funds, like mutual funds, holding a basket of assets, stocks, bonds, whatever. But the key difference is how they trade.
They trade on stock exchanges.
All day long, just like an individual stock. You can buy or sell them anytime the market is open. That's very different from traditional mutual funds, which only get priced and traded once per day after the market closes.
So that real-time trading gives you more control, more liquidity.
Exactly. That liquidity is a huge plus for many investors.
Okay, let's break down the core benefits Reynolds highlights. Why are ETFs such a powerful tool, especially for retirees building that income portfolio? Benefit 1, diversification.
This is maybe the most fundamental benefit. When you buy shares of a single broad market ETF, you're instantly getting ownership in hundreds, maybe thousands of different underlying companies or bonds.
Built-in risk reduction.
Absolutely automatic and powerful. Instead of trying to pick individual winners and losers, which is incredibly difficult and risky, one purchase gives you broad exposure. A total U.S. stock market ETF, for example, covers almost the entire U.S. equity landscape. It protects you from the disaster of having all your money tied up in one or two stocks that go bust.
That foundational protection. Benefit 2, cost effectiveness. This seems like a really big deal in the book.
It's huge, especially over a 20 or 30-year retirement. Every fraction of a percent you pay in fees is money that's not compounding for you. It's fighting against that silent thief of inflation.
And ETFs are generally cheaper. Why?
Mostly because of passive management. The majority of popular ETFs aren't trying to beat the market. They're just trying to match a specific index, like the S&P 500 or a broad bond index.
No expensive fund managers trying to pick stocks.
Right. They use computers and algorithms to replicate the index holdings. This is much cheaper to operate. And those savings get passed directly to you, the investor, in the form of much lower expense ratios. Reynolds hammers this point. Aim for expense ratios well under 0.50%, ideally much lower, often in the 0.0-something% range for core funds.
Okay.
Those fees, compounded over decades, make an enormous difference to your final outcome.
Okay, diversification, low cost. Benefit 3, tax efficiency. This one sounds a bit more technical, but potentially very impactful for retirees.
It is technical but crucial. It has to do with the way ETFs are structured and how shares are created and redeemed this in-kind process. The bottom line for you, the investor, is that ETFs tend to generate fewer taxable capital gains distributions each year compared to many actively managed mutual funds.
So fewer surprise tax bills at the end of the year.
Exactly. And it gives you more control over when you realize capital gains, typically only when you actually sell your ETF shares. This is a major advantage for managing your annual tax liability in retirement. And it enables strategies like tax loss harvesting more effectively.
Benefit 4 seems more straightforward, flexibility and liquidity.
Yeah, we touched on this. Because they trade like stocks, you can buy or sell them quickly during market hours at prevailing prices. You can use sophisticated order types if you want. It's very flexible.
And finally, benefit 5, transparency.
This is important for trust and control. Most ETFs disclose their complete holdings every single day. You know exactly what assets your fund owns.
Unlike some mutual funds where you might only see holdings quarterly.
Right. That daily transparency provides a lot of comfort, especially for that David-type investor who wants to understand what's under the hood. It reduces the fear of hidden risks or style drift in the fund.
Okay, so those are the compelling whys for using ETFs. Now let's look at the whats. Reynolds breaks down the different categories available, showing how you can use them to target specific goals.
Right. There's a huge variety. The foundation is typically built with equity ETFs. These are focused on growth, tracking broad market indexes like the S&P 500, large U.S. companies, or maybe a total stock market index, or even small cap indexes if you want more aggressive growth.
Then the other side of the core portfolio, bond ETFs.
Exactly. These shift the focus towards income generation and stability. They hold various types of bonds, government, corporate, municipal. They provide lower risk than stocks and generate regular interest payments. They're kind of the cozy blanket, as Reynolds puts it, that helps stabilize the portfolio when stock markets get choppy. Really important for Susan.
What about tackling inflation more directly?
That's where commodity ETFs come in funds, tracking things like gold, oil, or a basket of commodities. Also, real estate investment trust, REIT ETFs. Real assets like property and commodities often tend to appreciate when prices are generally rising, so they can act as a hedge against that inflation eroding your purchasing power.
And you can get more specific too, right?
Oh yeah. Sector industry ETFs let you target specific parts of the economy. You might be bullish on technology, healthcare, energy, financials, whatever. And international ETFs are crucial for diversification beyond just the U.S. market.
Important caveat there, though.
Yes, absolutely. Investing internationally introduces different risks, currency fluctuations, political instability in other countries, different economic cycles. So while diversification is good, you need to be aware of and manage that added volatility.
And lastly, a newer category.
Thematic ETFs. These are built around specific long-term trends or even values. Things like clean energy, cybersecurity, artificial intelligence, genomics. They allow you to align your investments with big societal shifts or personal convictions. Can be part of that satellite portion we'll discuss.
Perfect segue. That brings us to section 3, building the core ETF portfolio. Reynolds makes a strong case here for simplicity, advocating a focused 3 to 5 ETF approach. Why so few?
Because complexity is often the enemy of good investing behavior.
Yeah.
When you own, say, 20 different funds, it becomes really hard to track performance, understand your true diversification, and resist the urge to constantly tinker or chase winners.
Decision fatigue.
Exactly. Decision fatigue sets in. A simple portfolio, maybe just 3 to 5 well-chosen, broadly diversified ETFs, is much easier to understand, monitor, and stick with through thick and thin.
So what would a simple 3 ETF core look like?
Typically, it would cover the main bases. One broad U.S. equity ETF, like a total market or S&P 500 fund. One broad bond ETF, like a total bond market or aggregate bond fund, for stability and income. And one international equity ETF to give you exposure outside the U.S.
Simple, diversified, low cost.
That's the goal. And again, the emphasis is always on picking funds with rock-bottom expense ratios, under 0.50% as a general rule, often much lower, and checking that they have a good history of tracking their benchmark index accurately.
Now, to structure this, he introduces a really useful concept, the core versus satellite strategy.
Yes, this is a great way to balance the need for reliable stability with the desire for potentially higher returns, or expressing specific investment views.
Explain the core part.
The core is the foundation, the bedrock of your portfolio. It should make up the majority, say, 60% or even more of your total assets. This part is invested in those ultra-low-cost, broadly diversified index ETFs we just talked about, total stock market, total bond market.
Designed for stability and market-like returns.
Precisely. It's the part designed to provide consistent, reliable growth and income over the long haul. It's the part that helps Susan sleep well at night, knowing her base is secure.
And the satellite?
The satellite portion is the smaller part, maybe 40% or less. This is where you can add a bit of spice. You can express your investment personality, maybe tilt towards specific sectors, themes, or asset classes you believe have higher growth potential.
This is where David gets to use his research.
Exactly. Maybe he adds a satellite position in emerging markets, or small-cap value stocks, or a specific technology ETF. It allows for potentially enhanced returns and lets you tailor the portfolio more, but without compromising the stability of the large core holding.
Can you give an example of a core satellite split?
Sure. A common one might be 60% core, split between a U.S. total stock market ETF and a U.S. aggregate bond ETF. Then the 40% satellite could be divided, say, 20% into an international developed markets ETF and 20% into a chosen sector or thematic ETF, like healthcare or clean energy.
So you get broad market stability plus targeted exposure.
That's the idea. It balances discipline with flexibility.
Reynolds makes this very practical by showing how you can build these portfolios using funds from major low-cost providers.
Yeah, he often uses examples from the big players known for low-cost ETFs. Vanguard is frequently mentioned as the pioneer of low-cost indexing. Their VTI, Vanguard Total Stock Market ETF, is a classic core U.S. equity holding. Pair it with something like VXUS or VEU for international exposure and BND for bonds, and you have a simple super low-cost core.
What about others? iShares.
iShares, run by BlackRock, has an enormous range of ETFs covering almost every conceivable market niche. Their IVV tracks the S&P 500, another very popular core equity choice. For bonds, something like AGG, U.S. aggregate bond, or GOVT, U.S. Treasury bonds for maximum safety, could fit in the core.
And Schwab.
Schwab also offers excellent, very low-cost broad market ETFs that are great for core holdings. SCHB for U.S. broad market, SCHZ for U.S. aggregate bonds. They compete heavily on fees, which is great for investors.
The point being, you have choices among good providers to build this simple, low-cost structure.
Absolutely. You can likely build your ideal core satellite portfolio using the commission-free ETF offerings available right at your own brokerage. The key is sticking to those principles. Broad diversification for the core, low fees everywhere, and targeted choices for the satellite if you choose to have one.
Okay, let's bring this home by applying it to our listener profiles.
Right.
How might the allocation look different for David, Susan, and Mike and Linda?
Right, allocation is deeply personal. For David, who's maybe younger, has a higher risk tolerance, and is focused on growth and wants that hands-on feel, his allocation might lean aggressive. maybe 60% or even 70% in equities, split between U.S. and international, perhaps 20–30% in bonds, and maybe a 10% satellite slice in something like technology or emerging markets.
More growth-oriented. What about Susan, who needs safety and income? Maybe she's already retired.
Susan's allocation needs to be much more conservative. Her priority is capital preservation and reliable income, so maybe only 30–40% in equities, and perhaps focused on lower volatility or dividend-paying equity ETFs. The bulk, say 50–60%, would be in high-quality bond ETFs, like aggregate bonds or even shorter duration bonds.
Yeah.
You might have a slice, maybe 10%, in REIT ETFs for income and inflation protection.
Much more defensive. And the couple, Mike and Linda, maybe in semi-retirement, needing balance.
They need a middle ground, perhaps a classic 50–50 or 60–40 split between equities and bonds initially. So 50% equity, diversified U.S. and international, 30–40% in bonds for stability.
Mm.
And importantly for them, maybe a dedicated 10–20% slice specifically in dividend ETFs.
Why the specific dividend focus for them?
Because it can provide a more consistent, predictable cash flow stream without necessarily having to sell shares as often, which might fit their needs for regular income during semi-retirement. It balances growth potential with income generation.
The big takeaway here is personalization.
Absolutely. Your ideal allocation depends entirely on your time horizon until you need the money, your personal comfort level with market swings, your risk tolerance, and your specific need for generating cash flow now versus maximizing long-term growth. There's no single right answer.
Okay, that leads perfectly into Section 4, creating reliable cash flow and income. This is really where the rubber meets the road for retirees. How do you turn this portfolio of ETFs into a dependable monthly paycheck?
Right. This is the ultimate goal. The portfolio needs to generate spendable cash. Now, ETFs help with this in two main ways naturally. Dividends paid out by the stocks held in equity ETFs and bond interest payments from the bonds held in bond ETFs.
But that natural yield might not be enough, especially with low interest rates sometimes.
Often, it's not enough on its own to meet living expenses, or it might fluctuate. That's why Reynolds emphasizes the importance of embracing the total return strategy.
Which means?
It means you're not relying only on the dividends and interest the funds throw off. You're looking at the total return, that's the income, dividends and interest, plus any capital appreciation, growth in the share price. To generate cash flow, you use the income, and you also strategically sell off a small portion of your appreciated shares.
Selling principal, essentially.
Yes, but in a planned, disciplined way. Ideally, you're selling shares when the market is up or has had gains, taking profits to fund your spending, while letting the remaining bulk of your portfolio continue to grow and compound over time to fight inflation.
Discipline sounds key here. It might feel scary to sell shares.
It does require discipline and a solid framework, like the buffer strategy we discussed. You don't want to be forced to sell shares when the market is down just because you need cash that month. But the total return approach is often necessary to generate sufficient inflation-adjusted income over a long retirement.
Let's look closer at the specific ETF types that help with income. Dividend ETFs. You mentioned these for Mike and Linda.
Yes, these are a cornerstone for many retirement income portfolios. These funds specifically invest in companies that have a strong history of paying dividends and often increasing those dividends over time. Think of dividend aristocrats or dividend kings.
What's the appeal?
Consistency and potentially lower volatility. Companies that consistently pay and grow dividends tend to be mature, stable businesses. Their stocks might not soar like high-growth tech stocks, but they often hold up better during market downturns, and that reliable dividend payment provides a steady income stream, which is psychologically comforting for retirees.
And the other income workhorse, bond ETFs.
The safety net. Bond ETFs provide that regular interest income. They help preserve your capital. High-quality bonds are less likely to lose significant value, and they provide crucial stability when stock markets are volatile. They act as the anchor or ballast for the portfolio.
Now, Reynolds includes a really important warning here about chasing yield, the danger of yield traps.
Oh, this is critical. It's so tempting, especially when you need income, to see an ETF or a stock advertising a super high yield, 6%, 8%, maybe even double digits, and just jump on it.
Sounds great, right? More income.
It sounds great, but it's often a major red flag. An unusually high yield can signal underlying problems with the company or the assets in the fund. That high payout might be unsustainable.
What are the signs of a potential yield trap? How do you look under the hood?
You need to do some digging. Check the underlying companies. Are their earnings declining? If profits are falling, How can they sustain that high dividend? Do they have high debt levels? Maybe they're borrowing money just to pay the dividend, which isn't sustainable. Look at their dividend history. Had they cut the dividend in the past during tough times?
Also, the payout ratio.
Yes. Check the payout ratio. What percentage of the company's earnings is being paid out as dividends? If it's consistently very high, say above 70–80%, that leaves very little room for error, reinvestment in the business, or surviving a downturn. The key takeaway is prioritize quality and sustainability of the dividend over the absolute highest yield number. A modest, reliable yield from a strong company is far better than a high, risky yield that could vanish, or worse, comes with significant loss of your principal investment.
Okay, so you've built the portfolio, you understand the income sources and the risks. How do you actually manage the process of withdrawing money smartly? Chapter 7 covers smart withdrawal strategies.
Right. The goal here is consistency and removing emotion from the process. Reynolds outlines a few common approaches. One is systematic withdrawals.
Like setting up an automatic transfer.
Exactly. You determine your annual need, divide by 12, and set up an automatic monthly transfer from your investment account to your checking account. Simple, predictable. Another is the percentage of portfolio approach.
A dynamic version of the 4% rule.
Sort of. You decide to withdraw, say, 4% or 5% of your portfolio's value each year. But the actual dollar amount will fluctuate based on the market. If your portfolio grows, your withdrawal amount goes up. If it shrinks, your withdrawal amount goes down. This helps ensure you don't deplete the principal too quickly during downturns, but it means your income isn't perfectly stable year to year.
Then there's the strategy you mentioned earlier that provides more psychological protection. The bucket strategy.
Yes, I think this one resonates with a lot of people because it directly addresses the fear of market downturns. You mentally, or actually, divide your assets into different time-based buckets.
Remind us how that works.
Bucket 1 is your short-term money. 1 to 3 years worth of living expenses held in cash, CDs, or very short-term bond funds. This is your immediate spending money, totally safe for market swings. Bucket 2 is for the medium term, say years 3 through 7 or 10. This holds stable, income-producing investments, primarily high-quality bond ETFs. Bucket 3 is your long-term money, for years 7 or 10 and beyond. This holds your growth assets, mainly equity ETFs.
And the benefit is when markets get rough.
Exactly. When Bucket 3, your stocks, takes a hit, you're not touching it. You're calmly spending from Bucket 1. Cash. You know Bucket 3 has many years to potentially recover before you'll need to draw from it. Refilling Bucket 1 happens strategically by selling appreciated assets from Buckets 2 or 3 during good market periods.
It separates your immediate needs from long-term market volatility.
Precisely. It mitigates that sequence of returns risk in a very practical, easy-to-visualize way. It provides enormous peace of mind, especially for risk-averse investors like Susan.
Okay, excellent strategies for managing withdrawals. Let's shift focus in Section 5 to protecting your future over the long haul. This involves planning for changes using concepts like the ETF glide path.
The glide path is a really intuitive metaphor. Think of an airplane landing. It doesn't just drop out of the sky. It makes a gradual, controlled descent. Your portfolio should do the same as you approach and move through retirement.
Gradually shifting from growth focus to income stability focus.
Exactly. You're gradually reducing the allocation to riskier assets like stocks and increasing the allocation to safer assets like bonds. It's not an abrupt switch on retirement day. It's a dynamic rebalancing through the decades.
What does that look like practically?
Well, in your pre-retirement years, maybe your 50s, your primary goal is still accumulation. You might be heavily weighted towards growth, maybe 70% or even 80% in equity ETFs. As you enter the transition phase, say your early 60s, getting closer to needing the money, you begin to de-risk. You might gradually shift towards a more balanced allocation, like the classic 60% equity, 40% fixed income bonds.
That 60-40 is often seen as a starting point for retirement.
It's a common benchmark, yes. It still offers decent growth potential, but with significantly more stability than an 80-20 portfolio. Then, as you move deeper into the retirement golden years and capital preservation and reliable income become paramount, the focus shifts further. You might end up at 40% equity and 60% income bonds, or even more conservative, depending on your needs and longevity projections.
And again, this needs to be personalized.
Absolutely. David, with a higher risk tolerance or maybe other income sources, might maintain a higher equity allocation for longer. Susan, prioritizing safety, will likely start her glide path descent much earlier and end up with a more conservative final allocation. It has to match your individual circumstances.
Beyond managing the asset mix, we also need active strategies for that silent thief. Inflation hedging techniques. What does Reynolds suggest?
Well, one of the most direct tools is investing in inflation-linked securities. In the US, the most common type is TPS Treasury Inflation Protected Securities. You can buy these through ETFs.
How do they work? How do they protect against inflation?
Their principal value is directly tied to the Consumer Price Index, CPI, the main measure of inflation. When the CPI goes up, the principal value of your TPS bond is adjusted upward. Your fixed interest rate is then paid on that higher principal amount.
So your income from the bond effectively rises with inflation.
Yes, it provides a direct, guaranteed hedge against unexpected increases in inflation, something regular nominal bonds don't offer.
What about other inflation hedges?
Investing in real assets is another key strategy. This means having exposure, perhaps through ETFs, to things like real estate REITs or commodities, like gold or a broad commodity index. These physical assets often tend to hold their value or appreciate when the general price level is rising.
And within your stock allocation,
Within your equity holdings, it's wise to focus on companies that have strong pricing power. These are businesses, often with strong brands or dominant market positions, that can successfully pass on their own rising costs, materials, labor, to their customers in the form of higher prices without losing sales.
so they can protect their profit margins even when inflation is high.
Exactly. That helps ensure their earnings and potentially their dividends can keep pace with inflation over the long run.
Okay, let's tackle the tax efficiency and strategy angle again, because as you said, it can really impact your net withdrawals.
It's crucial. First, just reiterating the inherent ETF tax advantage. That structure generally leads to fewer unexpected capital gains distributions compared to many mutual funds. That's a baseline benefit.
But the bigger lever is how you manage withdrawals across different account types. Tax-smart account strategies.
Yes, the order in which you tap your different retirement accounts in retirement can make a huge difference to your lifetime tax bill. This is really strategic.
What's the generally recommended withdrawal sequence?
The goal is to let your most tax-advantaged accounts grow for the longest possible time. So the typical recommendation is to withdraw first from Roth IRAs or Roth 401k.
Because those withdrawals are completely tax-free.
Correct. Maximize that tax-free growth and withdrawal benefit. After exhausting Roth accounts, or if you don't have them, the next place to draw from is generally your taxable brokerage accounts.
Why taxable accounts before traditional IRAs?
Because withdrawals from taxable accounts are typically taxed at lower preferential long-term capital gains rates, assuming you've held the assets for over a year. Ordinary income tax rates are usually higher, so you tap the lower taxed money next.
And only last, you touch the traditional IRAs and 401ks.
Generally, yes. You withdraw from these traditional tax-deferred accounts last, often only starting when required minimum distributions, RMDs, force you to, typically starting in your mid-70s now.
Because those withdrawals are taxed as ordinary income, likely at your highest rate.
Exactly. By deferring those withdrawals as long as legally possible, you're strategically deferring your potentially largest tax liability, allowing those funds to continue growing tax-deferred for longer. And for proactive investors like David, Reynolds also mentions using tax loss harvesting in those taxable accounts along the way to offset capital gains and further reduce taxes.
That makes a lot of sense. Okay, we've covered the portfolio construction, the income generation, the protection strategies. Section 6 brings it all together with the habits of the smart retiree. This feels less about the what and more about the how and why of behavior.
It absolutely is, because even the perfect investment plan can be derailed by human emotion. Reynolds is very clear. Our emotions, particularly fear and greed, are often our own worst enemies when it comes to long-term investing.
What are the common emotional traps he highlights?
There are several key ones. FOMO, the fear of missing out, which often causes people to chase hot investments near their peak, buying high. Then there's panic selling fear takes over during a market downturn, and people sell low, locking in losses. Overconfidence is another. After a long bull run, people forget risk exists and take on too much. And loss aversion, the pain of losing, is felt more strongly than the pleasure of gaining, which can cause people to cling to losing investments hoping they'll recover instead of cutting losses.
So how do you fight these deeply ingrained emotional responses?
The antidote, Reynolds stresses, is discipline and consistency. Having a well-thought-out plan before emotions run high, writing it down, and then having the discipline to stick to it.
Easier said than done sometimes.
It is. But tools help. Staying educated about market history helps you understand that volatility is normal. Using strategies like the bucket system helps create psychological distance. And crucially, separating your self-worth from your portfolio's daily fluctuations. Mindfulness can actually help here.
And consistency is key for long-term success.
Consistency is everything. It's the key to weathering volatility. For example, if you're still accumulating, using dollar cost averaging, DCA, investing a fixed amount regularly, regardless of market highs or lows, takes the emotion out of timing the market. And consistency allows the power of compounding to work its magic, especially with dividend reinvestment, like Susan would focus on. It's the slow, steady, consistent approach that wins the long game.
To maintain that discipline and ensure the plan stays relevant, Reynolds emphasizes one final crucial habit: the annual retirement checkup checklist.
Yes, this is non-negotiable. Think of it like your annual physical, but for your finances. Once a year, you need to sit down and systematically review everything.
What's on the checklist?
Key items include reviewing your spending plan. Has anything changed? Are your assumptions still realistic? Assessing all your income sources, Social Security, any pensions, and importantly, your investment withdrawals. Checking your ETF performance against their benchmarks. Are they doing what they're supposed to? Rebalancing your portfolio back to your target allocation if market movements have caused it to drift significantly off course. And critically, checking and forecasting healthcare costs, as these are often the biggest unpredictable expense in retirement.
So it's an ongoing process, not set it and forget it.
Definitely not. This annual checkup ensures your plan stays aligned with your life, your goals, and the market reality, not just based on assumptions you made years ago.
Well, this has been incredibly thorough. This deep dive into Retire Smarter with ETFs really does seem to confirm its value. It covers the big picture risks like longevity and inflation. It provides the practical tools with low-cost ETFs. It shows how to tailor strategies and gives that framework for sustainable cash flow.
I agree. Mark Reynolds delivers a truly comprehensive toolkit here. It's designed to help you reclaim that sense of confidence and security around retirement finances. It really moves the conversation from, fear and confusion towards clarity and control. For anyone looking to build that resilient, steady cash flow portfolio using ETFs, it provides a very clear path. It is definitely a go-to resource. If you find this book interesting and right for you, check out the link below.
And remember, the goal isn't just getting to retirement, it's about retiring smarter. As Reynolds implies, you are the author of your own retirement story. So think about it.
Yeah.
What's the next small, consistent, disciplined action you can take today? Maybe reviewing your expenses, maybe setting up that buffer, maybe making your first core ETF purchase to help secure the tomorrow you envision.